Everybody, Darin Garman here with Trot. Hello, Trot.
Darin, how are you today?
I'm wonderful, and we are rolling into spring as we are recording this. And the good news is it doesn't have to be spring for those watching or listening to gain the value that they're going to be getting, which actually you will be getting some value out of this episode. I'm looking forward to talking with you because I know you got some pretty good questions for me regarding some things that we're going to be talking about on the Heartland Multifamily Show, the place
for all things multifamily.
For all things multifamily. And we are, like I said, recording this in the spring of the year and looking forward to it. We got a lot of things going on. We recently purchased another apartment community, working on that. And related to that, I know that you wanted to take this episode to ask me to do a little bit of Q&A, I think, on a question that we get quite a bit from investors. And it just kind of happens that we get this question, I think, more towards the beginning parts of the year and then kind of more towards the ending parts of the year as people really start thinking a lot more about this kind of stuff. But glad to have you here. How you been doing?
Good. Very good.
Good. Looks like you got you have a fresh cut there?
Yeah.
It's looking good.
First time I've gotten, what do they call it, a bald fade.
What's it called?
A bald fade, I think.
Really?
A low bald fade.
They just called mine the receding hairline. Yeah, right. That's what they call mine. It's good to. I'm glad you're here, and I'm glad we got this time to chat a little bit. So let's talk about this. I know that you wanted to take an episode to talk about at least one of the, I guess, frequently asked questions that we get when folks are deciding what they want to do or where they should be investing some of their money, specifically when it comes to multifamily. So why don't you roll with that? Why don't you start with? Why don't you hit me with maybe one or two of some of the more frequently asked questions that we're getting.
Well, we get a lot of people that come up to us and they say, hey, Darin and Trot, what do you think is the best way to go here? Should we, invest in your fund, or should we invest in one of your single properties, your standalone, no entity, or entity, right, but right, not part of the fund deals?
Right. So So I mean that's a really good question, and we get that question a lot. So for those that may be kind of wondering, what do you mean fund and single property? So what that means is we have, at least how we do things here at our shop, what we do is we have two tracks that investors go with us when they want to own multifamily, passively especially. Okay. The first is our multifamily fund. And what a fund usually means is owning more than one property. That's typically what a fund is. And so not unlike other funds that might be out there just under the umbrella of a fund, the fund owns many properties. So the fund that you're talking about owns a little bit over $70 million of multifamily, some commercial, but a little bit over $70 million of multifamily. Okay, so question is, do I go into that fund that owns, over $70 million of all of these properties? Do I do that? Or do I get involved in maybe a single property purchase? So here's an example. So we just got done purchasing a 102, interesting number, but that's the number, 102 unit apartment community. And so we have investors that invest just in that. Okay. So do I invest with you, Darin, on just a 102 unit apartment community or something like that? Or do I go into the fund where I own a lot of properties? What's the better way to go? That's pretty much the question we get a lot, right?
Yeah, and an easy way to look at it too, and to break it down is, should I buy a mutual fund or Apple stock? So it's pretty much the same thing.
That's a good analogy, I guess. When you're coming from that world, I think that's a good analogy for people to maybe get their mind wrapped around it. And so your question is, what's the better way to go?
Right.
Well, so before we go down that road, let's talk a little bit about how maybe some of these are similar.
Right.
Because I think that might be a pretty good a pretty good way to go. So first of all, both are really good tracks for those that want to own multifamily properties, get the benefits of all the ownership and being actively involved day to day and being involved in it, all the income and the tax benefits, but without, of course, having to be actively involved in it, but getting the benefits as if you were actively running the show and managing the property. So they're both similar in that way. Another way that they're similar is, and I'm talking now specifically here in the heartland of America, here where we're at. They have what I call, both of them have 5 pillars of benefit, 5 pillars. And by the way, I recommend this be a part of every multifamily investment, not just what we do here in the heartland, but here with what we've got going on, we happen to have these 5 pillars with either fund way or single property way. And so let me touch upon those really quick because it's important for everybody to know these. Pillar number 1 is protection. And so the properties need to not only, get you a good rate of return, but they need to protect your money. And that's protection from economic, political, and social BS that goes on out there that impacts a lot of other investing, especially stocks.
Right.
The stock market goes up and down based on, what's going on with the war today and what's happening over, in China. It's a lot of that's, and so you need multifamily in a place that's not impacted by that. So number 1 is protection, and both offer that. Number 2 is insulation. And you may be thinking, if you're watching or listening, you may be thinking, well, what's the difference, Darin? Protection, insulation, what's the difference? Well, insulation, your money from the bad guys. And so what do I mean by bad guys? So, Trot, when's the last time you heard there was a data breach somewhere?
Basically every day.
Every damn day. Yeah, so...
And big time data breaches, not just, hey, my Facebook got hacked. We're talking Facebook got hacked.
Yeah, a data breach was stealing your information and also stealing your money. And unfortunately, we've had instances where we've talked with people that have had money stolen from brokerage accounts, from bank accounts. They've basically been hacked into, and their money is gone. And so you can't hack into a 200-unit apartment community. You can't hack into, the ownership of 30 different properties. You can't hack into that. So that's what I mean by insulation. So there needs to be some insulation there. The third pillar is, of course, rate of return. You need to have a good rate of return. And I mentioned as number 3, and mainly because, not number 1, because if you don't have that insulation and protection first, the rate of return doesn't do you any damn bit of good
Right.
unless you get that figured out. So it has to be a good rate of return. Pillar number 4 is tax savings. So I want to be able to have a nice income from my properties. I want to be able to defer capital gains taxes and show legal losses on my tax returns. Again, legal losses on my tax returns. And we know that the real estate that we have here does that. And then number 5, which I would never think I'd have to mention this as a pillar, but is the multifamily investment in a market, in a place that is socially and politically congruent with your thoughts and your beliefs. Okay, so I used to not have to even think about that, but now you do. It doesn't make sense if you lean one way politically or socially to be investing in multifamily in a market, in a city, in a state that leans the exact opposite way. It's really counterproductive. Do you really want to be getting your reports and reading what's going on and be really frustrated by what you're reading? No, you don't.
Or even with the general partner too. If your beliefs are congruent to, or I guess contrary to the general partners as well.
100%. If you are all about climate change, okay, and you've got somebody that's working with you and kind of running the show that's not, or vice versa, that can be a problem. So you've got to have that pillar in there too. Used to never have to worry about it. Now you do. So anyway, whichever way you go, whether you go with fund with us, owning a whole bunch of properties at one time with my investment, or single property, Darin, the 102 unit, the 128 unit, 200 unit property, whichever way you go, both of those do allow you to implement the 5 pillars. So that's like the first litmus test you got to be asking yourself and going through. Okay, are those 5 pillars important to me. So that's number one. Okay. Number two, here another place where they're similar, is you both of them need you to be thinking as an investor long term. Okay, so this is not let's get into it in March and be out of it, hopefully doubling our money by September. That's not what we do here. That's not the deal. You need to be thinking a place to park your money for a minimum of 5 years. I mean, you need to be thinking in like 5-year chunks and 5-year time frames in order to give yourself the adequate amount of time to reap the most benefit from either the fund direction, if that's the way you want to go, or the single property investment direction, if that's the way you want to go. Okay, so those are how they're similar. Okay, and I think before you can either decide, geez, do I want to do this passive fund thing and own all these properties? Or do I want to get involved in that 200-unit apartment community? Before you decide which direction you want to go, you need to be on board with what I just said, with that overall premise with how both of them are similar. And if you are, then you dive deeper into this. If you're not, then I think you go a different direction altogether. That makes sense?
Oh yeah.
Good.
So then how are they different? You know, we went through the similarities, but how do they differ?
So how are they different? That's a really good question. So, there's probably 2 or 3 ways that they're different, and they're each of them are important. The first one is not going to really surprise anyone. So the first one is risk. And so, not surprisingly, when I go the fund direction, there's less risk there because I'm more diversified in the amount of properties and the number of properties that I have. So if the fund owns, let's just say 30 different properties, which I think it does, if 3 of them have an issue or a bad year, bad quarter, have a problem, something comes up, something unexpected, I got 27 others that are going to make up for the 3 that might not do as well. So there's power in that diversification. So that power translates into less risk. Compared to if I own just one property and that property, let's say, does really well for 2 or 3 years, all of a sudden there's a big issue, a problem, a foundation starts to crack. The property next door starts to have environmental issues maybe. All of a sudden, whatever could happen to that property, that one property that could be negative, could have a pretty serious impact because I have no other direction to go other than that one property. So the first one is risk, and you've got less risk with the fund direction versus the single property purchase direction. So that's number one.
So usually when there's more risk, you know, there's a higher upside. Is that the case with this too?
Yeah, maybe, but it depends on this. It depends on goals and time frames. So here's an example of what I mean, and to answer your question, and I promise I'll answer it. Usually when you invest, like if you invest in our fund, it already has properties that have an average track record of over 10 years of operations, running, moving, etc. So when you're involved in our fund and you invest in the fund, you're already investing in properties that have track record. They're already operating and running, and you can look at historically what's been going on, etc. But that's not always the case with a single property purchase. So with this 102 unit property, let's talk about that because it's a good example. So we know that after we purchase it, we're going to have about 15 to 18 months of work to do there. And in this case, I'm not talking so much capital improvement work or we're going to go in there and rehab all the units work, which that could be part of it.
Right.
That could be, but that's not what we're going to do. We're going to be going through the process of making some changes to the the structure, the leasing structure of the property. And once we go through that, it's going to take us about 15 to 18 months with some minor improvements to the property. Then that property will be, in our experience, will be at a point where it should be operating at its maximum capacity. But here's the point. It's going to take us 15 to 18 months to get there. Okay. So you need to be an investor that knows that and is aware of that right up front.
Right.
So if I'm an investor and I want, monthly income is really important to me, then you don't want to be involved in that single property purchase, because the first 18 months, there might not be any income coming from the property because we're working on it. It's part of the plan. It's part of what we're doing. It's not a surprise. But if that's your goal of monthly income, then that's not an investment you want to be in. So to answer your question, it depends on goals, and it depends on the objectives of what the investor wants to achieve. Do I want to get into a single property purchase where there's maybe more balls up in the air and maybe a little bit more risk, but maybe more reward too? Do I want to do that knowing that there's some caveats to this, but at the end of the day, it's something to do? Or do I want to get into maybe something like our fund that's got those 10-year plus track records of properties already operating, already under management, already, we already know what they're going to do pretty much. Do I want to do that? So that answers that question. What is the better direction to go? Depends on those goals and objectives.
Gotcha. That makes sense.
Yeah. And so, thinking about that, the question that I then get related to that has to do with, okay, Darin, which gives the better rate of return, right? Which usually the better rate of return? And by the way, as we already talked about with those 5 pillars, it shouldn't all come down to rate of return, because there's got to be some protection and insulation parts of it. But what gives you the better rate of return? And if you compare apples to apples, not surprisingly, so which one have I mentioned so far that has more risk?
The single property.
Mm-hmm.
Yep.
Why does a single property have more risk?
Because there's nothing to protect it down the road, and there's not 30 other properties if it's lacking to support it. Mm-hmm. It's just on its own. Yep.
So it's on its own. So it has more of a possible downside to it. Now, of course, we do the best we can to mitigate all of that. I mean, we're not even investing in buying the darn thing if we think there's going to be huge problems, obviously. But okay, there's one property, so there is more of a chance that there could be an issue, right? Why else would I want something that, like this property, a single property investment or purchase with us, like this 100+ unit property we're talking about? We've already said there's a little more risk with it, but there's a little more possibility of what else with this too. With more risk will come what?
More reward.
Which means more of a higher
return, or, even sometimes it's higher ownership percentage and stuff like that.
Yeah, so, and that's the thing. So you hit the nail right on the head. What you've got with the single property purchases when it comes to return is they will typically give you, if you have them side by side, the single property investment purchases will typically give you a little higher, better return, but there's more risk, right?
Right.
And so we have, here's how investors typically work with us. We have investors that they'll only do the fun thing because there's a little bit less risk and it's got that rate of return that they're happy with. I'm happy with that. That's what I want. Less risk. That's where I'm going. Okay. Then we've got the folks that, hey, I want a little bit more risk. I'm ready to take that on. And maybe if it's even like IRA or 401k, they might even be a little bit more interested in a little bit more risk. And so they'll do that single property investment. And then we've got folks that'll do both, right? We got lots of investors that, I want to do the fund with you. Let's do that. I'm involved in that. And at the same time, I'm going to put some money in some of that single property investment stuff too. And so, there's really no wrong answer, but to answer that, what really gives me the best rate of return, it's those single property purchases, but you got to know you got a little bit more risk involved with that as well, right?
Right, yeah. And which do you prefer then?
Well, I like them both.
Okay. So you're a depends scenario.
Well, so So if the question is, what's the better way to go? If we were to talk about what's the better way to go, it now then really comes down to what the investor is looking for in the next 5 years. Okay. And so everybody that's watching this and listening to this has a different financial picture and a different place they want to be 5 years from now, let's just say, 10 years from now. And of course, the answer to that is always we want to be the best place we can be. I mean, That's like the answer. But how do we do it where I can get the best benefits of that? Again, those 5 pillars, get good return on my money with that risk level that makes sense to me. And everybody is different. And so what that means is that with 99% of the investors, and you know this that contact us, they're in. Okay, everything you said makes sense. I'm in. How do I get involved? So it's not really a question of which one. It's not really a question, of do I want to do this? It's now a question of which direction do I go? And like I said, we've got some that go one way, another way, some that go both. Okay. But what I recommend people do is, based on how their financial picture is, you pick a place that you want to go and you spend the first year or two making sure that this is what you thought it would be like, right? And what most people find out is, yeah, it is. And most find out that it actually turns out better than what they thought. And now based on that, maybe I want to go from the fund, and now maybe I want to get involved in that next single property purchase, right? So when you got something that comes up, so I just got off the phone with somebody this morning before I got into the office. They called me. We actually drove by each other on the road. Okay, we recognized each other. And he called me. He said, hey, the next deal that you got coming up, I couldn't get involved in the last one because of this, but the next one you got coming up, make sure you call me. I want to be involved in that. Okay. Well, they want to be involved in the single property purchase. They've done the fund thing. Now they want to be involved in a single property purchase. And that's kind of how it goes. That's typically the way it goes. And so, two quick things on that. Number one is there really is no specific place people should go because it all depends on them.
Right.
And so one will have a better feeling and a better outcome for our investors versus another, at least in the beginning. And we find that you can either stay there, you can move if you want to something else, you can do both. So that's number one. But number two is what I make sure that we do is we have basically what I call a multifamily strategy session. Right. And you've been involved in these where, they've kind of raised their hand. They said, yeah, Darin, Trot, I want to be involved with what you guys are doing. The next, when can I do this? How does this work? What are my next steps? The next step is a multifamily strategy session where we go over a list of questions one-on-one. And after we've gone over those questions and based on the answers that our investors have to those questions, then we can pretty much 99.99% say, okay, here's the direction you got to go. You got to do the fund.
Yeah.
Okay, that's where you got to go based on the answers to your questions. Or it may be, you might want to get involved in our next single property purchase that we decide to get involved in and pick up. But it comes down to having that strategy session, and then the answers that come out of that strategy session then point people in which direction they want to go. And as I've said, there are people that just stay in the fund and that's their lane. There are those that stay in that single property, that's their lane. But we have a lot of people that do both.
They're double dipping, yeah.
They do both.
Yep.
And for obvious reasons, they want to have the benefits of both. And so they end up doing it. But with every single investor, though, it's got to start with that strategy session where, having done this for 30 plus years, I know the questions to ask. I know what's going to make sense to people. I know the directions and the answers that they need to have to decide which direction they go. And then that's the direction that we decide that they need to go in. Awesome. And probably what I think would be really good is if anyone is maybe watching or listening and they're thinking about maybe a multifamily strategy session, Trot, why don't you give them the URL or the website if they ever want to, schedule a strategy session with us. And by the way, before you do that, this is not a, let's get on the phone so we can sell you something. That's not what this is. Because frankly, I don't really care. We don't care if you get involved with what we do. It'd be great if you did, but we're not here to sell you anything. We are not salespeople. We are investors, and that's what we do, and that's what we've been doing for decades. Okay. So Trot, do you have why don't you give out a website or URL that if someone wants to have one of these strategy sessions to, decide, do I want to maybe go fund route and own a whole bunch of properties or just one? What's the URL?
Yeah, it's heartlandinvestment.com.
Okay.
Heartland is HEARTLAND. Investment, INVESTMENT.com.
Heartlandinvestment.com for that strategy session, right?
Yep, and Darin's got plenty of information on his own personal website at daringarman.com.
Yeah. There's a lot of good stuff there you can check out, of course. Thanks for the website and adding that in there. But yeah, there's really, at the end of the day, Trot, there's really no wrong answer. The fund is a good direction to go. You own a whole bunch of properties all at once. It's got your diversification. It has the 5 pillars in there, so that's a good way to go. The single property purchase too is a little bit different nuance to it, depending on the plan for the property, because that'll be different than what the fund plan is. And some folks will be all in on that plan. Other folks, maybe not so much. But that's a direction to go, and to figure out what's the best way to go. You want to get on that strategy session, and we go over, we have 8 to 10 questions that we get answered, and we'll know right away what's the best way to go and what makes the most sense for people. So then after that session, then they know what direction they should be focusing on getting involved in. Maybe it's not even with anything we got going on. So now and so you know what lane you're in versus trying to be in 5 different lanes at one time and not being as effective as being in maybe one investment lane. Regarding passive ownership of multifamily properties.
Right.
So Trot, any other things or takeaways that you've got that maybe we should think about or talk about regarding what we've gone over with fund versus, that single investment property? Anything?
No, I think you covered basically everything.
Okay. All right. So I want to thank you.
Thank you for having
that
me.
Question.
Yeah.
And want to thank everyone that has watched or listened to us on this episode of the Heartland Multifamily Show. Again, you got comments. We'd love to hear from you. If you've not subscribed to this channel, what is your problem? Get in gear, man, and subscribe to the channel so you're not missing out on anything multifamily that can have a pretty good impact on your financial world. So Trot, thank you.
Thank you.
Thank you, everybody. Have a great day, and we will see you later on the Heartland Multifamily Show. If you enjoyed this video and you want to make multifamily a bigger part of your investing world, make sure you click here on this video to discover the 3 easy ways to invest in and own your own multifamily property.